Good morning, good evening, and good night for some of you. Merrill Chandler here, your host of the Get Fundable podcast and your guide to the Get Fundable universe. In this episode, I'm really excited because a number of people have been talking that they're trading Bitcoin and they're into cryptocurrencies, but they don't know how it relates to fundability. And in this episode, we do a deep dive into exactly what it means and how we can actually plan for the future using these alternative, maybe soon to become dominant means of financing our futures and the opportunities to trade in these cryptocurrencies. So I'll see you on the inside.
In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome back, everybody. It is a fine day when the rules of fundability continue to be applied to newer and even more revolutionary banking opportunities. What do we mean by that? Well, just like I said in the intro, cryptocurrency is all the rage, right? Not just Bitcoin, but more and more newcomers are entering the market, and some are making killings, some are losing their shirts. But the question becomes, and what's come up for us before is, so how does fundability apply to cryptocurrencies? And here's the beauty of fundability. Fundability, by definition, is the positive effect of borrower behaviors such that it creates trust in lenders to give you money. That's what fundability is, the ability to get funding, but it's based exclusively on your borrower behaviors, the way you treat whatever money you've received. Now, so why cryptocurrency? Well, first of all, we've been doing the last few segments of the podcast have been all about how the definition of banking, the who's banking. We've been talking about neobanks, right? The new banking model, where just like we've talked about everywhere else, we've said that it is that banks want to go more online. While some of the big banks will never get rid of branches, more and more of the smaller tier banks are, and some of even Wells Fargo during the pandemic shut down a whole slew of branches. Everybody's moving online. They want to take checking accounts online. They want to, as we've discussed, do more, not just phone calls, but actual video conferencing now when somebody's setting up a new account. That's how they're building these relationships. But Bank of America, who's one of the more, I'll use the term stodgy, Bank of America, who is one of the more conservative of banks, is actually they're doing an experiment right now where they are allowing you to trade cryptocurrency with your accounts, right? Whether it's one of their money market accounts or where you can backstop a margin account. They're allowing, never before, but now they're doing tests on being able to trade cryptocurrencies, right? And so if Bank of America, one of the more conservative of the tier one banks, if they're saying, you know what, we'll allow the trading of crypto shares with funds that are resident in one of our accounts, then that's a bellwether move into what the attitude is towards how acceptable cryptocurrencies are, right? And so, I mean, you've been able to trade gold futures and harvest futures, right? Wheats and everything. You can backstop a margin account from Bank of America for everything. Well, now moving in cryptocurrencies is allowing one more level of legitimization of this phenomenon, right? I can't call it new, but it's barely a decade old. And so what does fundability? How does fundability play within this? Well, as I was saying, that fundability is simply the quality of your borrower behaviors such that you inspire a lender to give you money. Period. And if you're already building a relationship with a lender, those that what they call internal performance data, that's their language. I call them borrower behaviors. Those borrower behaviors are being measured fastidiously to see whether or not they want to raise limits, give additional loans, or back a margin account for cryptocurrency. So the good news with this digital move, more and more banks are moving to digital interaction with their customers. Cryptocurrency is just another thing to back a loan with. For example, let's say probably the next move once you can buy cryptocurrencies on Bank of America margin accounts, the next move is likely for any bank to do is, will you back a loan with cryptocurrency? Now, the number one indicator of a commodity, whether it's wheat or gold or cryptocurrency, the number one indicator is there enough confidence in that market for someone to use it to backstop a loan, to use it as collateral or security for a loan? That's the number one indicator. So if you can put, I have 17 tons of wheat futures, and I want to borrow $100,000, will you collateralize my loan with these wheat futures? The answer is yes. Commodities they've been borrowing against commodities for decades, if not centuries, right? So what's up next? Cryptocurrencies. And so far, we do not have, or there's not a public brouhaha of being able to back loans with cryptocurrency, but that's the direction we're headed. And this move from Bank of America gives us that sense that they're saying, well, if it's legitimate enough of a commodity to trade dollars for crypto, then the next logical step will be to have crypto be the commodity that backstops any other loan. So now the last question, the bottom line question for us regarding crypto is, when that day comes, and it's coming, when crypto in its various forms, and remember, the first one to be legitimized, of course, is going to be Bitcoin because of its track record. It's got a long period of being a commodity that has been traded, and and besides any cooling off recently, there have been periods of cooling off before, but it's way more valuable now than it was 11 years ago. So remember, what a lender who is going to lend money to you or extend credit to you wants to make sure that that security that's backstopping that loan, they want to make sure that it's not going to devaluate too much over the course of your loan term, right? If they're going to lend $100,000 to you and you've got 300,000 in Bitcoin, they don't want the value of Bitcoin to go to 50 grand so that you're only partially securitized or collateralized. They don't want that. So the only time that a commodity is used to backstop a loan or to be the security of a loan is when it has some significant version of either uphill movement or that it's stable, right? And then they're going to 2x, 3x the amount of the loan in case of loss. So, and all my musings about backstopping loans, the bottom line for us, you guys, is that fundability metrics will continue to apply. It does not matter if the loan is securitized by Bitcoin or wheat or gold or anything else. The question is, the lender is going to measure what your borrower behaviors are as you pay it back. They're going to see what your do you get ahead of the payment slope, as we talk about in the boot camp, or what kind of utilization are you going to have if it's a credit line that's being backstopped? How do you use the lent money? That is fundability, and those principles are not going to change, because the confidence they have in the loan being given is not based on the security of it. It's based on your power to repay and the process of your repayment. So, bottom line for us guys, crypto is good news, because if you've got crypto as part of your asset base that you want to be able to do high level loans from, or margin accounts that are backed by crypto, then the principles of fundability are still going to apply. Everything that's in in the new F word, it doesn't matter what is my best-selling book, is still going to apply. Everything that we teach is still going to apply, because, and the next stage, to conclude here, the next stage after, well, it's true enough of a commodity to buy and sell using cash in a Bank of America account. The next one is, can I borrow cryptocurrency? That is going to be the telltale sign, is, can I take a loan out in crypto? Fundability principles will still apply. This is Merrill Chandler. Thank you for joining me on, once again, the Get Fundable podcast, where we take on how do the fundability principles apply everywhere we go. You have an amazing day.
Thank you for listening to the Get Fundable podcast. Please leave comments, because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast, because we want them to get fundable too.